all during the bull market, actually since the 2015 low, but especially over the last year, the staircasing process, we had 3 steps up for gold, 1 back, or for silver, it's like 4 steps up and 2 back, will end, and that we're going into a more accelerated phase.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 24th through March 3rd, 2025, while supplies last. Our choice 1-ounce backdated silver Royal Canadian Mint Wildlife Series coins are just $2.99 over spot per ounce. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back.
Well, it's great to have you today. We're seeing gold rebound today back towards 2,900. And you've been talking about on your reports on Momentum Structural Analysis that really this pullback that we saw that a lot of people were concerned about really was a nothing burger. Your perspective on what we're seeing right now.
Yeah, back in March of last year, after about almost 3 years of sideways in gold and downside staircase in silver in the miners, we argued that the pause, which is what we defined that period as, not a topping action, was over and we're going back up again. Okay, so it's March of last year. Gold was just above 2,000 again. It'd been there 3-4 times before, but this time was different. Silver was 25 to 26. We've since seen 35. And GDX, for example, the gold mining ETF was 31.5. It's been up over 40. It's over 40 today. But during that surge of the last 11 months now, there have been multitude of pullbacks in gold where I don't pay too much attention to internet chatter. My son does. He tells me what's going on with the popular opinion. And it seemed like every time gold would do that, yeah, it's the top, oh no, or we're going to have to correct for 6 months and, all this stuff. And if you go back in the weekend report, I put an arrow in each of those spills, the little drops that gold had. And there was one of them that was 9% and one was over 6%, but most of them were about 5 or so percent. The one we just had last week, from last week's high to last week's low, which is the peak to the low so far, was 4.3. And yet, people have still said, oh, that's it, 3,000 was it, we can't get through there. If you look at the price chart even, and look at prior highs, when gold makes a high, even the prior highs during this last year, where it drops, 5-6% or so, and it takes maybe a month or two to get back up. This one had 3 weeks in a row at the same high. Within a few dollars of each other. You don't top that way. If you're going to top that way and it create a correction, you create a spike and then you drop. Okay, you don't keep coming back to the same level. And so obviously there was a crowd of folks saying, okay, 3,000 is a big round number. I'm going to sell just short of it and risk a nickel and make a dime. Okay, well, they risk a nickel and now so far they ain't made any money. Okay, we think that probably was it. It was a protracted daily decline actually for momentum, even though for price it was like a 1-week phenomenon. But I think that's probably over, that last dip, false top. And you get back to the highs again, they're gonna this time I think it's gonna be different in that the process we've seen all during the bull market, actually since the 2015 low, but especially over the last year, the staircasing process, we had 3 steps up for gold, 1 back, or for silver, it's like 4 steps up and 2 back, will end. And that we're going into a more accelerated phase. So that's what I see happening here. And I think it's going to be coincident with the breakage we're already seeing in the stock market. It's already commenced with the S&P. Some other key markets around the world, the Sensex in India is a bubble as well. It's broken. It's our quarterly structures. And the Nikkei 225 has. So we've got three major markets around the world, which are all would be qualified as big bubbles, given the multiples of gains since 2009. And they're breaking structure. The only one we're waiting on is that NASDAQ 100. And it's dancing around the number right now as we speak. And I just want to close a week below it. And so we'll see. Last week got below it, and 15 minutes to the close on Friday, they zoomed back above our number as if they knew. So anyway, we think the stock market breakage is more fuel for gold. Not what most people think, which is, oh my gosh, if stocks go down, gold goes down. That is not a good truism at all.
Now, I've heard that really since 2008, that is what happens is when stocks go down, gold goes down. So what makes you confident that it won't happen this time?
Well, if you go back in history, you'll find that is a rarity. Okay. In the weekend report we just issued, we did some studies going back to that 2007 to 9 period, which is what everybody's got burnt in their memory. Yes, there was a month in that bull trend in gold, which remember had begun from a 2001, 2002 low, down around $260. So it was already in process upside. But in that 2007 period, like spring to the fall, yes, gold weekly price was somewhat in sync with the ups and downs of the S&P. And then we showed that when the S&P made its final peak in October of 2007, 1 month after the Fed began surprise rate cuts, by the way, gold was still somewhat in sync in these little weekly moves. And all of a sudden, there was a sharp break in the S&P from a November high to the January low of 2008. And at that point, when it really counted, gold shot up. So there was all these seeming linkages that you could see suddenly went sour in a big way when it really counted. In other words, when the big move occurs. And yes, during 2008 in October, a full year off the stock market's peak, the stock market produced what you could call a crash type month, 30+% on the downside in a matter of weeks. It was in October of 2008, a year after its high. Gold participated in that 1 month cataclysm and immediately reversed, and within a few months was back to its high again, while the S&P continued down until 2009. So yes, you can find a month during that 10-year bull trend in gold, 10, 11-year bull trend, where, there was a month they did the same thing. But if you believed that and got out of gold, you missed the entire move. It went to 1920. Well, the stock market took until 2013 before the S&P could ever get back up to its 2007 high. So, gold, meanwhile, had gone off the page during that time period. So, yeah, don't make the mistake of finding points of linkage that you think are truisms, because over time they don't work out.
Now, when it comes to the stock market, can you expand on exactly what your momentum analysis is showing? Because I know in your recent report, weekend report here, you were saying that it's pretty rare to have, just waterfall declines and crashes in the stock market, but it's more likely that we would just see a slow downward trend.
Later down move without crash. In 29, we had a crash coming off the high. In 87, there was a crash that did not lead to a bear, and there's reasons for that. The annual momentum was not broken. It was just the quarterly. In our case, we're going to have a nightmare situation as we have both annual and quarterly in jeopardy. But the point is that it's rare to have a bear market that begins with a crash. Most of the bear markets you go back and look at in the stock market, like in the mid-70s to the 74 drop, it was late in the bear market where suddenly you had a crash type event. And by the way, during that time, gold was exploding, okay? 74, gold was going off the page, stock market was imploding. So don't forget that. The dot-com high, there was no crash. NASDAQ 100 dropped 82% over 2 years, but it wasn't a crash, meaning A crash is like 30 to 35% in a matter of a couple of weeks. Like that's what happened in 29, it's what happened in 87. And also the COVID event was a crash type event. But don't expect that this time. I see enough reasons to see layered decline in the market. Oh, decent drops, but not what you could call a crash. And in the past, you get those kind of events, it's not going to impact gold. It's fuel for gold. Why? Because two reasons. Money in the stock market, which we know is enormous, will seek a new place. It doesn't all get burned up in the fire, okay? Smart money starts to move. It's already begun to move. It's pretty evident. And where does it go? You go back as far as you want. It goes into gold. Well, you have a stock bear market, and it goes into T-bonds. And this time, I think T-bonds are already indicating something's going on because they're going up, and it's not because Fed's cutting rates because they don't control the long end of the market. But T-bonds are rallying while the stock market is getting nervous, in our terms, actually breaking stuff. And gold has been rising. So money is already flowing there. The question is an acceleration in that money flow. And that will occur once you knock them in the face once or twice. And we think the first drop in the S&P will be about a 20%er. In other words, if you look at an S&P price chart or a NASDAQ 100, I go back to the 2021 or 2022 highs. NASDAQ 100 peaked in November 2021 and then had its drop. S&P peaked in early 2023 and had its drop. You go back to those highs, that's about 20% off the recent highs. And I think the price guys are going to want to buy that old high, thinking, oh, let's support. And we've got momentum reasons to assume that there might be temporary support there. So what we're arguing is, yes, even if you break our key numbers, which most indices have done, except the NASDAQ 100, which is the leader, we think there'll be a slab of decline, the kind that upsets people. No, it's not going to terrify. It's not going to be a crash, I don't think. It'll be a layered process like most bear markets are. But even a 20% jolt, if you're an average Joe out there and there's one thing that makes you smile over the last year, not consumer prices, not your mortgage, not, et cetera, not your credit card debt, but your retirement account. Oh boy, it went up 20% last year. If all of a sudden you shave about 20% off that thing, then they don't have anything to smile about anymore. And that's when you inject emotion into markets. It's when, nothing looks good. What do I do? And that's when you'll see more money flow into gold-related, and we argue especially into the miners.
In the time frame on this, your perspective on that, because it seems like just looking at the stock chart, just the pricing, it definitely seems like it could be topping out at the moment.
Yeah, I think it probably has topped. The question is to get a sufficient break to where we're confident. And I'm telling you, the NASDAQ 100 is trading above and below our key number last week. And even, if you close much down this week versus last, you're going to break our number, in which case we think the process is really underway because, again, NASDAQ 100 is the leader. While the S&P went up ninefold from its 2009 low to recent highs, NASDAQ 100 went up 18-fold. And just like the dot-com process, when it broke, it was the leader then, internet stocks. S&P dropped 50% 2002, but NASDAQ dropped 82%. So NASDAQ 100 will be the leader on the downside as well, but it hasn't broken our structure yet. But we think when it does, and you start to feel the jolt and the what's going on comments, that's when you'll see more of that money flow into gold. And that's when I think it will be, as I call it, the wet bar of soap time. Everybody grabbing for it.
No, a lot of people
I think that would be soon, too.
A lot of people are obviously eyeing the 3,000 level. Do you think that is significant? And could that maybe be the trigger for all of this?
We pointed out in August of last year, a couple months after our breakout in March, that likely there would be price chart type selling around 3,000. Well, one, because it's a round number, and we know idiots love round numbers, so they like to play round numbers, okay? Like $200 gold back in 1975, happened to be a round number. Now, the 1980 peak wasn't a round number, but anyway, they think 3,000, it's a nice big round number. And so you had 3 weeks of selling at that same level, just below, 0.5% below 3,000. And we said there might be some resistance there. And I think it will be the type of resistance we're just seeing, which is to say, ho-hum resistance, just pause. And when you go through that, people say, well, where's it going? And all these big brokerage firms that analyze gold that we see reports from, they have a target of, about 3,000. Then suddenly they change, 3,100, but 3,300, 30, and they keep raising it. But it's sort of silly. They don't realize that even if you just look in the past, over the last 50 years when gold was legalized in the U.S., there have been 2 moves that were at least eightfold. And there were different time durations. One took 3.5 years, 1976 low to 1980. And one took 11 years from 2000 to 2011. But they're eightfold moves. Well, if we had an eightfold move, we'd be $8,000 gold. And we're not projecting that as a target. We're just pointing out the fact that gold has done this before. It's no big deal to do it again, especially given the fundamental factors that are in play and becoming more in play now in the world and in markets and so forth, especially when bubbles break, because then money does flow elsewhere.
It seems like the factors in play are even more intense this time. I mean, you have, instead of 1980, just the U.S. really being involved in the gold markets, is the whole world, and also you have these major players like central banks moving into gold more aggressively. So it seems like maybe the 8,000 mark would be a conservative number.
Yeah, I've got some friends who are fundamental analysts, names who speculated they could go based on certain metrics they look at, not technical, go up in the 20,000s. I don't know. We're not projecting a given target. We're just saying there will be an acceleration phase. There certainly was, in the move to 1975 high, then the move up to 1980. There were phases in the last year of the move where suddenly it changed. It was no longer normal action. It was abnormally upside. And we haven't had that. We've gone to 3,000 in layered, cautious staircasing process. And I think that's about to end because factors will shift. And the main one, again, is the stock market. And we know that the other factor, aside from money flowing out of that market, will be central bank response. We know that the Fed, the ECB, the BOJ, and any other central banks will panic. And once they panic, money flows.
Now, last time we had you on, you made the point that silver has actually outperformed gold in the last year or so. I think it may be slightly reversed now, but your take on silver at the moment, it seems like it's, at least in the last month, not doing as well as gold.
Yeah, if you look at it carefully, it will swing better than gold and then swing worse than gold. It's more volatile. So there's some up moves. For instance, when gold was capped at 2,400 for several months, silver wasn't. It went from like 31, 32 up to 35. And gold didn't go through the 2,400 zone, and yet silver did. So it exceeded gold then. And then in pullbacks, invariably, silver will underperform gold. We're watching the spread relation between silver and gold and the miners and gold. And technically, we're watching it. And we see on the spread charts trend structures such that if you get in the next few days or weeks, even modest outperformance by the miners to gold and outperformance by silver to gold, that you're going to break those spreads out of a process of correction that's been going on in those spreads since mid-2020 to 2021 highs when silver outperformed gold and the miners outperformed gold. Since then, they have corrected on a performance basis, and they've got breakout levels not far above, and where at levels you won't notice just looking at their price charts. This is a spread relation, don't look at their price charts, that indicate upside resumption. And this is what happened, for example, in silver in the 79 to 1980 move, the last year of that bull market, and also in the 2010 to 2011 surge, which is the last year or so of that bull market. Silver vastly outperformed gold. It's like exploded. We think that the miners in particular have demonstrated over the last 10 years, since the 2015 bear low, if you look at their spread chart versus gold, they're actually at a higher level than they were then. Now, it's still at a very low range historically of the miners versus gold compared to where they were, for example, back in prior to 2009. They were much higher relative levels. But it's a base, and they've not gone back to the low of that base. Now, what does that mean? It means they've demonstrated over the last 10 years, we're not going to underperform gold anymore. And sure enough, that spread relation, if you take the current reading of the spread, it's higher than it was at the 2015 bear low. So their underperformance to gold ended then. And since then, yes, they've gone range bound in performance to gold, up and down, but what you call a par performance. But they're actually higher net price-wise, measuring from the 2015 low to their current price than gold is relative. For instance, XAU index as of last week's close was 3 times its low of 2015, whereas gold is 2.7 times its low in 2015. So actually XAU index, which is still at very low levels in relation to gold, is been outperforming gold. Minor amount, but outperforming. Nobody would believe that. They think, oh, it's underperforming. The question is, if you could break it out of this basing pattern on the spread, we think gold miners could triple their current relative performance to gold over the next year or so. In other words, if we enter an acceleration phase in the net price of the monetary metals, we think we're also going to see silver outpace gold. You get up to more or less normal levels, like 2% of gold, whereas right now it's 1.12% of gold, which means a doubling in its value to gold. And the gold miners, we can give you an example. Gold mining, XAU versus gold is like about 5.5% of the price of gold. You go back to the 1980s through 2006, 2008, its low spread reading was 17.5%. It had been in a range between 17.5% and 35% of the price of gold, and it collapsed in 2015 to 4% of the price of gold. That's like free, okay? I mean, it's not going to zero, okay? And it's now 5.5%, so it's higher than it was then. But if you take it from its current level and run up to the bottom side of that multi-decade relative performance and bump the floor, the old floor, it's a tripling in the current value of the miners relative to gold. And we think that is very realistic. What does that mean? It means the money flow out of the stock market doesn't rush into silver futures or gold futures. It goes into miners. Miners are cheap. That's a virtue. They've proven they're not going down anymore. And on a relative basis, they've got a lot of dynamic potential on the upside. And I think the money from stock market longs will move into gold mining long positions.
Now, just on the retail side, what I'm seeing last month, probably when we had you on, or about 2 weeks ago, there was probably like a 2-week period where we saw very strange pricing on the premiums, right? It was low on the buy side, low on the sell side. It was pretty much the lowest that I've ever seen relative to the spot price. Now we're seeing that reverse. So I don't know if you have any perspective on that, how it seems like maybe the retail public is starting to jump back in at the moment where it seems like...
We don't measure that. Yeah. And I know that's a point of commentary among a lot of analysts, and I don't disagree that there, it probably indicates something about futures contract deliveries and so forth and so on. But we sense and know from what we've read that especially U.S. investor interest in the gold miners has never been so low in history, okay? And their capital commitment and their leverage in the U.S. stock market has never been so high. Okay, so they're highly vulnerable to breakage in their stock positions because not only are they long, but they're like triple long. They're using a lot of leverage, more so than ever before. And therefore, there's vulnerability there. And when you look at the gold miners, both in when we measure like the XAU or GDX versus gold, or XAU GDX versus the S&P, we see the same situation. They're very low. They've not been going lower in relative terms, despite the public sense that they have. They've not. They've really held their ground. In fact, XAU index from December 2015 to the present is actually up more than S&P is from its 2015 low price at December 2015. So nobody believes that, but it's a fact. We think that could shift. And when it does, because of the tiny nature of the gold mining sector, it would be a panic situation. It'll just change the nature of the behavior of the gold miners in terms of volatility, upside, and so forth, which will shock a lot of gold investors because who are in the miners, who are more or less bored to death by them or scared to death by them every time they dip. But I think that's the reality that's about to dawn. And I think just watch the mama market gold. If the gold goes up and goes through 3,000 and takes out that silly high, then it's telling you this is another BS sell-off. We've had like 6 or 7 of them in the last year, and they don't amount to anything. And $3,000 is an idiot level. Okay, and we're going to accelerate. And I think for silver, I'm using May contract now, which is a 32.40 area. You get much above 33 again, I think silver is going to start to accelerate. And if you look at the gold miners, just a simple monthly price chart, not momentum, just go back to the 2015 low and look at XAU and look at GDX. Over the last 3 years, they keep coming up to the same general level, which is a flat ceiling. XAU, for example, is trading either side of 160. Now, if you go back 3 years, you'll find that there's like 5 or 6 monthly closes. There are a couple percent either side of 160. That is not a top, folks. You do not top a market that way. When you top a market, you generally peak it, drop, and you can't get back to the high. You keep coming back to the high indicates, no, that's a launch pad. And I think that's about what's going to happen here.
Then rounding up for our viewers, you mentioned how the shift is probably going to be happening soon. What are the key indicators that people should be looking out for?
We think it's the NASDAQ 100 again because it's our leader. And there's certain sectors out there that seem to be defying the drop we're seeing in the tech leadership. The Magnificent Seven are dropping now, whereas financials, for example, are making new highs, XLF ETF. We think that is a trap. We think it's a exhaustion spike in the financials that will fail. But also, I think it's probably driven by a false assumption, and that is, oh, good, long rates are starting to drop. Well, the reason for the long rates starting to drop is probably not good for the stock market. It's indicating an asset flow into a, quote, alternative sector, which has historically, go back especially the last couple of bull market peaks and bear markets, have risen while the stock market went down because investors and asset managers move there as a place of safety. And I think that's what's helping cause the T-bond market to rally of late, is the beginning breakage that we're seeing in the stock market. So it's really not a positive thing. And plus, in the past, whenever rates start to drop, it's too late. The bubble's already broken. Every time, 2000, 2002, 2007 to 2009, rates collapsed. Fed cut rates like crazy. It didn't help. The bubble broke. And I think we're on the cusp of that again.
Again, for our viewers, olivermsa.com is the website. Tell us a bit about that.
Well, we look at all 4 major asset categories because it's important to do so, because they're like tectonic plates. They're bumping into each other and they're impacting either positively or negatively. And that's very important. So if you're in gold, don't just look at gold. Look at the stock market. Look at the bond market now, which is saying, yep, there's some scared money starting to move out of the stock market. It's important stuff. Dollar index, for example, has been dormant as heck for 3 years now, basically in a monthly peak close to low monthly peak, low close, but a 7% range for 3 years. That's like a sleep. So major Forex has not been a impact factor in other markets. But right now, the dollar index is about 2% above a level that if it drops down to and closes a month at, we're going to blow an annual momentum trend structure that goes back a couple decades. Meaning our momentum work says, the floor is coming out. And suddenly at that point, you're going to have another major asset category become a wave creator. And it will be a wave creator that hurts many of the foreign investors who've piled into the U.S. stock market. Because when they bought through dollars to buy their stocks. And suddenly they get hit by one, stock market dropping, and two, the dollar dropping. So watch that factor. And that will impact gold as well.
Fantastic. Well, Michael, we really appreciate your time today. Thank you so much. And it sounds like exciting times ahead very soon.
I think 2024 will be quite a year.
Fantastic. Thank you so much, and you have a great day.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 24th through March 3rd, 2025, while supplies last. Our choice 1-ounce backdated silver Royal Canadian Mint Wildlife Series coins are just $2.99 over spot per ounce. Pre-1965 mixed junk silver is just $1.99 over spot per ounce. And pre-65 half dollars are just $2.25 over spot per ounce. Backdated 1-ounce gold South African Krugerrand are just $49 over spot per ounce. And 10-ounce silver Nordic Mint bars are just $2.10 over spot per ounce. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.